So prices for commodities are down about 12% year over year when they were down 20 to 30%. So once more, we're comparing this to drops that happened last year. Look at the Bloomberg Commodity Price Index again. It is still going down. That's a sign that inflation is coming soon. According to the PPI figure from last month, prices are up 1.1% year over year. In other words, the Fed wants the rate of inflation to stay at 2% year over year. Two of the most important measures are well below that level: commodity prices. The economy is getting worse, even though the U.S. added 209,000 jobs in June. It was the worst win since December 2020. It was worse than the 240. 000 experts predicted that the 309 million that was added in May would happen. A record low of 3.6% jobless rate was reached for the 30th month in a row, and jobs were added. The U.S. job market is still strong, even though the Federal Reserve is trying to slow down the economy. Rate hikes for more than a year have made prices go down. After taking a break in June, Fed Chair Jerome Powell said that rates will go up again this month. The wage increase from one year to the next was 4.4%. The Federal Reserve wants the U.S. rate to be twice that amount, and some economists are worried that sudden rate hikes could lead to job losses and a slump. Cathie, CEO of ARK Invest, talks about recent and future financial and economic data. Like the movie, sign up and post below. We are about to start the marketing season for the next election. In turn, this means that we'll probably get stuck, which is the better thing. From a fiscal policy point of view, it means that there won't be much to shake up the markets over the next year. That's good. In terms of monetary policy, the Federal Reserve still doesn't talk about the money supply, which I find interesting. The amount of money in circulation is down about 5% from one year to the next. The Fed hasn't said anything about it. I haven't, but you might have. It is still very focused on jobs and prices. When it comes to jobs, there have been so many signs in the last week or so that both bulls and bears could find something they liked. We got the non-farm wages today. The number of 209,000 was less than expected. 230 was what was expected. But what was important was that 110,000 jobs have been taken away in the last few months because of lower revisions. That meant that this report wasn't very good when it came to jobs. However, the average hourly wages were a little higher than what was thought. That might not have been good for the Fed. And the average work week was a little better than we thought it would be. It's likely that all of those added up to something a little weaker than imagined. There are now many signs for us. The ADP report for jobs came out on Wednesday and it was almost 500,000. Of course, that made the market shake. In today's news, jobs for households. You already know that's what we're focusing on because it includes more small businesses, which are very important at turning points as a leading sign. The number of those jobs went down by 310,000 last month, but they came back this month, not all the way, but 273. It was said today that contract work was very, very weak in the report. That week, I don't see it very often, so I wrote that down. This week, we also got the news on job openings. The number of open jobs also went down by about 500,000. As I already said, there's something for everyone, even the Fed. It looks like the Fed wants to pay attention to the better marks. That's it for the job side. When we look at inflation, we can see that product prices started dropping pretty sharply a year ago. Now we'll look at the similarity with that drop. In other words, product prices are down about 12% year over year, when they were down 20 to 30%. In other words, we're comparing this to drops that happened last year. Look at the Bloomberg Commodity Price Index again. It is still going down. That's a sign that inflation is coming soon. This past month, the PPI said. The private sector said the job market is better than expected, which is what the Bureau of Labor Statistics found in their most recent report. ADP, a private payroll service, says that private employers added 497,000 new jobs last month. This was a lot more than the 267,000 jobs added in May and a lot more than the 222 million jobs added that analysts had expected. The nearly 500,000 increase was the biggest monthly gain in more than a year. Most of the new hires were for leisure and catering jobs. There are also other signs that the job market is getting less busy. There are fewer jobs available in the United States. As of May 1st, there were 9.9 million open jobs, which is 9.9 million for every person who is technically unemployed. There are 6 jobs available. In March of last year, there were a record 12 million open jobs. This is less than that, but it is still more than before the pandemic. Cathie also says what she thinks about the growing number of lawsuits and how they hurt the economy. From one year to the next, the U.S. was up 1.1%. In other words, the Fed wants inflation to stay at 2% year over year. Ahead signs like commodity prices and the PPI, which is only up 1.1%, are both well below that. There is a number called the retail sales deflator that you have to go back and look at. Not many people pay attention to it, but it is part of the retail sales report, which is more about goods than services. That number is up 0.2% year over year, which is a measure of consumer inflation. The CPI is here. The most recent reading was 0.1% month to month, which is very good and stable month to month. However, it is still up 4% year over year. This coming month, in June, this report should be out next week. We will compare it to the same month last year. The CPI went up 1.2% from May to June of that year. The CPI will drop by a full percentage point if it only goes up 0.2% month to month this month. This will bring the year-over-year drop from 4% to 3%. I know that's a lot to take in at once, but when we look at it in light of a huge rise last year, it's clear why we went from a year-over-year rise of 4% in May, according to the CPI, to a drop of 3% in just 1 month. So if it's less than 0.2%, we'll be falling below 2%, maybe to 2.8% or 2.9%. Last month's CPI was up 2.2% if you take safety out of the picture. That was the CPIX protection, which went up 2.2%. Why should we care about that? The most lagging measure in the CPI is shelter. You can see that rents are starting to go down year over year in many parts of the US. If you look at online signs that are updated every day, it may be flat across the country as a whole. That's pretty cool then. There's also something called Trueflation out there. It looks at 11 different readings of the data, 10 million different readings made all over the country. This is a unit used in the United States. It is measured every day to compare it to the same time last year. We can get this every day. It's on the web. The difference between this year and last is 2.2%. There is a lot of proof for the Fed that inflation. To fight inflation, the Fed will raise rates. This means that more businesses will fail in the coming months. Rose in May, which showed that U.S. companies will have to deal with rising interest rates, higher costs for refinancing debt, and an unsure economy. Moody's Investor Service predicts that 41 U.S. and 1 Canadian debts will go into default this year, which is the most in the world and more than twice as many as in 2022. Fed Chairman Jerome Powell said this week that interest rate hikes would stop for the year unless inflation goes down. Analysts and beggars agree that rising interest rates are the biggest threat to businesses that need a lot of cash. Too much debt repayment costs a lot of money. It is normal for companies to trade or buy back debt in distressed exchanges. In the worst situations, restructuring could happen in or out of court. Most Maggie, a founding partner at the restructuring and consulting company M3 Partners, said that getting money costs more. Check the fees for debt. Rates on debt borrowing have been between 4% and 6% on average over the last 15 years. The cost of debt is between 9 and 13%. Many things have been busy for Ming GC's company since the fourth quarter. He thinks that companies that aren't in too much financial trouble will have trouble refinancing because interest rates are too high. It was almost as many bankruptcy cases as in 2022, with 324 on June 22nd. SP Global Market Intelligence saw more than 230 bankruptcies in April, which was the most since 2010. More than the long-term average of 4.1%, Moody's thinks the world default rate will rise to 4.6% by the end of the year. The rate will go up to a high point of 5% in April 2024 and then go down. What do you think about these predictions? Leave a comment below. To show your support, please like, follow, and turn on alerts. Thanks for coming. What?